Well, I am Jaginder Rana, and topic of our discussion today is tax benefits from insurance. Tax benefits from insurance. The insurance plays a critical role in tax planning. By investing in a life insurance plan, you can claim deductions from your taxable income as per the provisions of the Income Tax Act 1961. This means that the insurance premium you pay help in reducing your tax liabilities. So in case of some life insurance products, majority proceeds also come under exempted incomes. This means no tax is payable on the benefits received on maturity or on death. So subject to provisions of section 10(10)(d), hence life insurance products are one of the best ways to ensure that your family is always protected while enjoying tax benefits. There are certain important sections which provides the tax benefits. Says section 80C. You can claim deduction of life insurance premium paid from your taxable income as per the provisions of section 80C. Actual deduction is restricted to 10% of the minimum capital sum insured or premium paid, whichever is lower. So further, the overall limit of deduction available under section 80C is rupees 1,50,000. Then comes section 80CCC. You can get deduction from your taxable income towards premium paid for pension policies up to a limit of rupees 1,50,000. Surrender of the plan or pensions annuities received are taxable as per prevailing tax laws. And then section 80CCE. So under this section, the overall limit for deduction under section 80C, 80CCC and 80CCD1 is rupees 1,50,000. Now section 80D. You can get deduction of premium paid towards health insurance policies taken for self, spouse, dependent children and parents, and limit are as follows. Rupees 25,000 deduction is allowed for self, spouse and dependent children. Limit is rupees 30,000 if the age of insured is 60 years or more. Then additional deduction of rupees 25,000 towards health insurance premium paid for covering parents. Limit is rupees 30,000 if the age of insured is 60 years or more. Then section 10D. Proceeds from life insurance policies are exempt, subject to conditions of section 10(10)(d). And the last one is section 10A. Payment received on commutation of a pension policy is exempt from tax. So these are the provisions of tax benefits whereby you can save tax. Similarly, health insurance comes with a dual benefit for any policyholder. You secure your health while reducing your tax liability. So with health insurance, you can claim a considerable amount as tax deductible premiums paid towards your health insurance policy in a single year under section 80D of the Income Tax Act. So in several scenarios, you are entitled to a variety of tax deductions like this. Scenario 1. Maximum tax deduction of rupees 50,000 per year. Securing yourself, your spouse, and your dependent children with a health insurance policy, you can claim up to rupees 25,000 annually as tax deductible premiums paid towards your policy. So this is in the scenario that nobody in your family is over the age of 60. If you opt for a separate policy for your parents, you can make additional tax savings. So in case neither of your parents is 60 years or older, you can claim a separate deduction of rupees 25,000, up to 25,000 as tax deductibles premium paid towards the policy each year. This is about health insurance policy. Scenario 2. Maximum tax deduction of rupees 75,000 per year. See, assuming nobody in your family health policy is over the age of 60, you can claim a tax deduction of rupees 25,000 paid towards your health insurance premiums each year. So in a separate policy, you pay the premiums for your parents, at least one of whom is over the age of 60. So for this policy, you can claim a separate deduction of rupees 50,000 annually. Scenario 3. So maximum tax deduction of rupees 1 lakh per year. In a family floater health plan, if any member is over 60 years old, you can claim a tax deduction on or up to rupees 50,000 annually, paid as health insurance premiums. So the second policy, you have to cover your or your spouse's parents. You can avail of a separate deduction up to rupees 50,000. Since one or both parents is over the age of 60. So the question is, how the tax can be saved on the health insurance policies under 3 different scenarios as per the Income Tax Act. This is explained here. And now, if you believe that you cannot avail of insurance tax benefits issued by private insurers, it is not true. If you buy life insurance policy from an insurer that is approved by Insurance Regulatory and Development Authority of India, you are eligible for an annual tax deduction up to rupees 1.5 lakh limit under Section 80C. So Section 80C of the Income Tax Act 1961 encapsulates the income tax benefits of life insurance policy. Under the section, the premium you pay for your life insurance policy is eligible for deductions subject to the conditions mentioned under Section 80C. Now, alongside this, you can also buy life insurance policy for your spouse or child and increase your life insurance tax benefits. So tax deductions under Section 80C is allowed up to premium 10% of the sum insured if it has been issued after April 1st, 2012. So similar to the tax deductions you avail on a life insurance policy, the exemptions are based on the date of issuance of the policy and conditions mentioned under Section 1010D of the Income Tax Act. So the exemptions applies to the insurance payouts and are a crucial part of the life insurance tax benefits. So for claiming exemptions, premium paid during any particular year during the policy term cannot be more than 10% of the sum assured for life insurance policies bought after 31st March 2012. Now, premiums paid during any particular year during the policy term cannot be more than 20% of the sum assured for life insurance policies bought between 1st April 2003 and 31st March 2012. So further, death payout will remain tax exempt under Section 1010D of the Act. In all these cases, the money you or your nominee receives at the time when a life insurance policy matures or as a bonus is entirely exempt from income tax under Section 1010D. Now, a life insurance policy not only safeguards your loved ones financially against unforeseen events, but also gives tax benefits. So claiming the maximum life insurance tax benefit is both simple and hassle-free. Now all you need to do is to understand which types of life insurance policy qualifies for the tax benefits. The maximum amount you can save when and how to claim benefits. So although you can avail of life insurance tax benefits, these benefits should not be only reason behind the purchase. Instead, you must consider different aspects of the plan, including the tenure of the life insurance policy you choose, so the premium payable, policy inclusions and exclusions, and implications of premium default. Then the income tax benefit of a life insurance policy depends on different factors, including its types and the premium you pay for it. So as per Section 80C, you can avail of tax deduction for the life insurance premium up to Rs 1,50,000 in a year. The life insurance tax benefits are not limited to the premium you pay during its tenure. As per Section 1010D, the maturity benefits of a life insurance policy are tax exempt, provided the premium you pay every year does not exceed 10% for policy issued after 31st March 2012 of the basic sum assured at any point in time during the tenure. The computation of a life insurance policy is vital to get the income tax benefits. It means that you cannot skip paying the premiums during the selected policy tenure to save income tax. In case you stop paying the premiums for your life insurance policy, your policy is liable for discontinuation, which means you cannot avail of the income tax benefits of the life insurance any further, and your life insurance benefits may be affected. So you can ensure uninterrupted payment of the insurance policy premiums by choosing a suitable payment mode. You can either pay the premium either in one go or throughout the policy tenure or on a monthly or annual basis? Thank you very much.